or wherever you are, and whatever time you're listening to this, good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets. And this is with a view to helping you better understand how the markets operate so that you can make informed investment decisions. And how we do that is by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 200, and in this episode we're reviewing the performance of the financial markets during the 7th week of 2026, and that is from Monday the 16th to Friday the 20th of February. And without further ado, this is your host Jamhuri, and together, let's dive right in. We kick it off in the United States, where on Friday, the Supreme Court, in a majority ruling of 6-3, struck down President Trump's tariff agenda, delivering a major rebuke to the president's key economic policy. According to the Supreme Court, the law that the Trump administration relied upon to impose the tariffs does not authorize the president to impose tariffs. In defiance to the Supreme Court ruling, President Trump reacted by signing an executive order that imposes a new global tariff of 10%. Staying stateside, according to data released on Friday, the U.S. economy slowed more than expected in the fourth quarter of 2025 as the government shutdown impacted spending and investment, whilst a key inflation measure showed that higher prices were still a factor in the U.S. economy. According to the Commerce Department, the gross domestic product for the fourth quarter of 2025 rose at an annualized rate of just 1.4%, which was well below the Dow Jones estimate for a gain of 2.5%. Consumer spending increased at a slower pace for the period, whilst government spending declined sharply in the fourth quarter. That was marked by the longest government shutdown in U.S. history. For the full year 2025, the U.S. economy grew at a pace of 2.2%, down from 2.8% in 2024. While economic growth slowed, inflation held steady in December, and according to the Fed's preferred gauge for inflation, that is the Core Personal Consumption Expenditures Price Index, inflation rose by 3% in December, up from 2.8% in November, and remains above the Fed's target rate of 2%. Over to the Far East, Japan's economy narrowly avoided a technical recession as it grew by 0.1% in the fourth quarter of 2025, compared with a contraction of 0.7% in the third quarter, but still fell short of market expectations, which had projected a growth of 0.4%. For your information, a technical recession is commonly defined as 2 consecutive quarters of economic contraction. According to the data from Japan's Cabinet Office, private consumption is what drove the modest growth in the fourth quarter, offsetting weaknesses in exports and public spending. In the United Kingdom, the sterling pound dipped and British government bond yields fell on Tuesday after data showed that unemployment in the United Kingdom rose to a 5-year high. The UK's earnings and employment report for January 2026 showed that the number of payrolled workers fell by 0.4% on a yearly basis, down to 30.3 million workers. This number was 134,000 fewer employees compared with January 2025 and was down by 11,000 from the previous month of December. Meanwhile, the unemployment rate rose to 5.2% in December 2025. Staying in the UK, according to the latest figures from the Office for National Statistics, inflation in the United Kingdom cooled off to 3% in the month of January 2026, down from 3.4% in December. Core inflation, which excludes food and energy prices, came out at 3.1% in January, down from 3.2% in December. This data will be closely analyzed by the Bank of England as it looks for further signs to confirm its view that inflation was falling closer to its 2% target rate by April, when it is expected to cut its policy rate. On Wall Street this past week, stocks rose on Friday after the Supreme Court ruled against President Trump's tariff policy, potentially providing relief for companies affected by the higher cost of imports and easing concern about inflation, which remains sticky in the U.S. economy. In response to the ruling, the S&P 500 advanced by about 0.7% and closed at 6,909, whilst the tech-heavy Nasdaq Composite gained by 0.9% and settled at 22,886. Meanwhile, the Dow Jones Industrial Average recovered from a 200-point loss earlier in the session and added about 230 points before coming to a close at 49,625. In the government bond market, the yield on the 10-year Treasury bond ticked higher on Friday after the Supreme Court ruled against President Trump's tariff policy and as investors monitored the latest economic data. Bond investors are worried that the loss of the tariff revenues could further exacerbate the country's fiscal deficit and negatively impact the demand for U.S. debt. It's currently estimated that tariffs are contributing about 0.5 percentage points to the rate of inflation in the United States, and therefore the key implication of the Supreme Court ruling is a downward revision to the inflation forecast, and this will make it a lot easier for the Fed to cut interest rates going forward. In response, the yield on the short-dated 2-year Treasury note climbed by more than 1 basis point to close at 3.48%, whilst the yield on the benchmark 10-year Treasury bond rose by less than 1 basis point to settle at 4.08%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, the price of crude oil was stable on Friday after President Trump said he was considering a limited military strike in order to pressure Iran over its nuclear program. The US and Iran have held talks in Switzerland this past week to try and resolve a standoff over Tehran's nuclear program. Initial reports of progress, however, gave way to accusations from the US that Iran had failed to address its core demands. In addition to that, traders in the energy market continue to monitor supply risks in the Middle East. And as at the close of trading on Friday, the international benchmark Brent crude rose by 10 cents to close at $71.76 per barrel, whilst the U.S. contract, that is West Texas Intermediate crude, fell by 4 cents to settle at $66.39 per barrel. In the precious metals market, the price of gold rose by more than 1% on Friday, supported by weaker than expected US GDP data, while investors digested the Supreme Court's ruling against Trump's tariff policy and the subsequent executive order that proposes to implement a new 10% global tariff. Despite the back and forth, the futures markets indicate that traders are still pricing in at least 2 rate cuts of 25 basis points each in 2026, with the first rate cut expected in June. For your information, gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't pay out a regular coupon like a bond. All said and done, the price of spot gold was up by 1.5% on Friday and eventually closed at $5,071 per ounce. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where the Kenya shilling remained fixed versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at the same rate for the past 2 weeks, which was at 129.02. Meanwhile, the sterling pound was priced at 174.00, and the euro was valued at 152.12. And on the regional front, one Kenya shilling was changing hands for 27.62 Ugandan shillings and 20.07 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.28. The IMF has previously raised concerns about the extreme stability of the Kenya shilling, but the central bank insists that it continues to operate a floating exchange rate policy. However, the data tells a different story, as the dollar shilling rate has been staggered between 129 to 130 shillings over the past 2 years, and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased by $74 million for a grand total of $12.65 billion, which is equivalent to 5.5 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market was sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya Shilling Overnight Interbank Average, aka KESONIA, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate was stable at 8.77%, which is in sync with the revised central bank rate at 8.75%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this averaged at around 44.3 billion shillings. And just for your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 19th of February, and the central bank received bids totaling to 70.9 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of 295%. The central bank ended up accepting about 49 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by about 2 basis points to settle at 7.58%, whilst the 182-day rate also fell by 2 basis points to average out at 7.75%, and the 364-day rate declined by 7 basis points for a weighted average rate of 8.90%. At the Nairobi Securities Exchange, the Capital Markets Authority has approved the extension of the Kenya Pipeline IPO, which was initially set to close on Thursday last week, but has now been extended by 3 days and will now close on Tuesday this coming week. Top brokers who sought anonymity indicated that only about 20% of the IPO had been sold by Tuesday. The sticking point appears to be the valuation of the IPO, which the government has priced at 9 shillings per share, which is in sharp contrast to independent sources who have valued the IPO at 4 shillings and 61 cents per share. Staying at the exchange, data from the Nairobi Securities Exchange shows that the number of orders for listed shares has grown by nearly 4 times after the launch of Ziidi Trader, which enables shares trading via M-Pesa. The number of share orders grew to 26,169 on Monday this past week, which was 3.8 times more than the 6,761 deals that were recorded on the 4th of February, which was prior to the introduction of Ziidi Trader. Before the official launch of Ziidi Trader last week, the number of equity deals at the Nairobi Exchange averaged below 7,000 transactions per day. The data shows that the deals going through Ziidi Trader are low-value transactions with a combined market value averaging about 2% of total daily turnover. However, analysts are supportive of the small transactions as they have been significant in improving price discovery and establishing the direction of stock prices at the exchange. On Kenya's national debt, according to the latest data from the central bank, Kenya's national debt as of December 2025 stood at 12.29 trillion shillings, which was divided between domestic debt, which stood at 6.8 trillion shillings, and foreign external debt that was valued at $42.3 billion, which is equivalent to 5.4 trillion shillings. A recent debt sustainability analysis described Kenya's debt as manageable, but also highlighted a high risk of debt distress. In response, the National Treasury has developed a medium-term debt management strategy for 2025 that aims to reduce the debt-to-GDP ratio from 64% down to 57% by 2028. For your information, Kenya's debt ceiling limit was converted to a debt anchor that is now set at 55% of the country's gross domestic product. And given that our current debt to GDP ratio is estimated at about 70%, this means that the government is in breach of its own borrowing target. Up next is our topical issue. And this week, we are looking at Kenya's offer to buy back $500 million in Eurobonds. Kenya is offering a price premium of up to 5.5% to buy back up to $500 million of its existing Eurobonds in an effort to ease financing pressures. The tender offer, which opened on Wednesday, is targeting $350 million on the 12-year bond that matures in 2032 and $150 million on the 10-year bond that falls due in 2028. This is the latest in a series of bond buybacks by the government in the past 2 years and is part of a wider liability management plan that is aimed at lengthening the maturity profile of Kenya's public debt in order to ease repayment pressure on the National Treasury. A notice published on Wednesday by the London Stock Exchange, where the bonds are listed, indicated that the government has priced the tender offer at $1,055 per principal bond unit of $1,000, and that is for the 12-year bond, and at $1,035 for the 10-year bond. These prices represent a premium of 5.5% and 3.5% respectively, and this is based on the face value of the two bonds, which is the amount that investors would have received if they held the bonds to maturity. In a buyback transaction, the premium on the bond price is meant to entice the holders to sell the bond instead of holding it to maturity. The higher price also serves as partial compensation for the interest that bond holders were due to earn if they had held the bond to maturity. The Treasury will fund this buyback offer using proceeds of a new Eurobond whose sale opened at the same time as the buyback. The new Eurobond managed to raise a total of $2.25 billion, out of which $500 million will go towards buying back the existing bonds, and the balance of $1.75 billion will contribute towards the government's external borrowing target for the current fiscal year. The new Eurobond has been split into two tranches, with the first tranche being a 7-year bond for $900 million that was issued at 7.875%, and the second tranche is a 12-year bond for $1.35 billion that was issued with a coupon of 8.70%. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhuri@gmail.com. Jamhuri spelled JAMUHURI. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, success is stumbling from failure to failure with no loss of enthusiasm. A quote by Winston Churchill. Think about it. Thank you, and God bless.